Hi there, thanks for tuning in. Today, we're going to be doing an analysis and valuation of 1-800-Flowers. Let's get started. So, what are they? They're an e-commerce platform. Essentially, they have a bunch of gifting brands at this point, most famously 1-800-Flowers and 1-800-Baskets, where you can just send someone flowers or baskets, but they also have gifting platforms that can sell people berries, popcorn, chocolate, lots of little things. So they are essentially now just a gifting brand, an e-commerce gifting brand. If you want to make someone a very personalized thing and give them a gift with all sorts of things, such as popcorn, berries, chocolate, flowers, etc., you can do that through them. So this is a story of a brand that started as just 1-800-Flowers and eventually 1-800-Baskets and has grown into just a gifting company. They have over 11 million customers. They had a 2023 revenue of $2 billion. They also have 70% of their revenue from existing customers, so they seem to have pretty good retention there. And they have over 30 million gifts delivered annually, so that's cool for them. They have three business segments, really. They have the gourmet foods and gift baskets. They have the consumer floral and gifts. And they have BloomNet, which is actually a business to business. It basically is a wholesale merchandiser and marketer of floral industry and related products. So that's cool. And you have a history of acquisitions. So a lot of their growth nowadays is actually through acquisitions, which is just something to note. It's important to see whether or not the most of the growth is organic or is through acquisitions. Now, if these acquisitions synergize, it's actually pretty cool because they say, okay, you bought someone flowers, would you like to send someone else in the future a fruit bouquet? Now, that's a pretty decent way to keep customers in the loop. So I think it is a mix of both at the end of the day, their growth. They do have organic growth things, such as just integrating all the brands together or integrating products from multiple brands into a single gift. So it is a thing that's important to note, but they're definitely growing and they seem to have a lot of cash on hand as well to just keep making those acquisitions. So they also have lots of land with their parent peach trees in their orchards in Oregon. They also have a lot of personalization technologies as well as automated distribution facilities. Why am I putting this here in the presentation? Well, this actually shows that they have assets, they have land, they have machines. So this is something important to note because some tech companies are very asset light. So at least in the books, it looks like they don't have a lot going on. 1-800-Flowers is not quite that. They actually have stuff in the books. They actually have, for what's a tech or e-commerce company, a pretty high book value. They trade at 1.3 times book value right now, which if you look at certain e-commerce or internet related companies, they're trading in the 30s, 40s, 50s sometimes. So here's the revenue composition. So BloomNet is clearly a smaller part, but very important. The consumer floral and gifts and gourmet foods and gift baskets are half and half. And also you see the revenue by quarter. They have seasonality here. Essentially October to December and January to March are their largest cash cows. I wonder why. I mean, obviously there's not many gifts being given in July to September or it doesn't align with certain dates. So that's just something to note. They do have seasonality there. So there's going to be good quarter reports and bad quarter reports, just depending on that. Now, their historical revenue growth, and this is also why it's important to see historical yearly numbers instead of quarterly, because they have that cyclicality in the quarters. Their compounded annual growth rate is 11.9% from 2012 to 2022. Note that they don't include 2023 here because that would sort of muddle this figure. I don't like that. That's a little sneaky to do in the annual report. I don't love it. This is just a little tricks that companies do, but you do see revenue decreasing for the first time in a long time. Now, this happened before here in 2018, and they just bounced right back. I think the narrative, if you read the annual report, the letter from the CEO is basically saying, we're going to revert to the mean. So they said we had a tough year, we've had tough margin compression a little bit, but we want to revert to the mean. And you're going to see the same thing here with their gross profit margin. So usually their historical gross profit margin is about 42% from 2012 to 2021. Notice how they excluded the bad years here. Now they're saying we're going to revert to this mean, hopefully. And you could see a little bit of a bump here. Whether or not it continues is really up to them, but that's what they're trying to do. They're trying to revert to the mean. So here's a story of 10 years worth of net income and free cash flow. So this is in millions of dollars, and you'll see that from 2013 to 2023, the picture was improving basically, and then 2022 and 2023 were very weird years for them. So in 2022, they had negative free cash flow actually, and in 2023, they had negative net income. Now, what I'll note from 2023, the free cash flow is mostly positive because of two reasons. One of them being depreciation and amortization, and the other one being restructuring costs that they were allowed to write down. These won't be present next year. So that's just something very important. Or well, it won't be present in the future years at the very least. I think some of it will be present in fiscal year 2024 for them, but it's just something that it's a one-time benefit they're getting. It's not something you can expect to see every year. So they want to revert to this mean most likely with free cash flow and just have consistent generation without necessarily having it be restructuring costs. A good thing though is that they don't have a ton of stock-based compensation affecting their free cash flow, which is something great to see. But now we see that the picture's overall growing, but it's been volatile lately, especially after such a great year like 2021, which obviously was impacted because Americans had a lot of money to spend in that particular year. So will they be able to revert their fortunes and revert to the mean? We will see. However, the long-term picture is one of growth. Even these positive years did have more net income and free cash flow than 10 years ago. So you do see a positive trend. It's just a more volatile one lately. You also look at price and free cash flow and EV to EBITDA. You'll see that in general, this was growing, and now it's come down a little bit, especially the price to free cash flow, because free cash flow was decent this last year and the price was very depressed. Now, I think from when this measure was captured, the price has come up a little bit. So generally, this number may also come up a little bit. Now, this is important to just see it's relative to itself, but let's look at absolute metrics. So I'm going to do a discounted free cash flow model. What I'm going to say is usually their number of the percentage of revenue that they can turn into free cash flow is about 3%. So to predict revenue for 2024 and 2025, I'm going to take an estimate from Yahoo Finance. I'm going to take the low estimate here. I'm going to take a somewhat pessimistic analysis and just say, okay, they're going to make $1.85 billion in 24, $1.86 billion in 25, and I'm going to plug this into my model. So 3% of that for 2024, 3% of that for 2025, and then I'm just going to grow that at 2% for 26 and 27, 3% in perpetuity. Why? Because I think in the long term, they are going to grow. They're going to make an acquisition that's going to be great. The economic situation make it slightly better, which is going to be great. But yeah, I think, and my required rate of return is going to be 11%. That's 1% more per year than the market on average, and that compounds to be a whole lot in the long term. Now, if we divide that by the total number of shares out, the fair value of equity is $10.35. And if we subtract a little bit of net debt that they have, which is pretty much negligible, the fair value post-debt is actually $10.26 with an 11% rate of return and a 3% perpetual growth rate. Okay, let's check out where they're at. So 1-800-Flowers has traded very weirdly. If you'll see the euphoria here in 2021 and part of 22, or 2020 and 21 actually, had them at a very elevated price that frankly did not match their free cash flow generation. Since then, the stock has depressed a ridiculous amount. So it had touched the levels of 7 and 6, now it's at 10.50, and it's just something where this stock has reverted to a more rational or reasonable number that's more in line with its free cash flow. If you'll see here, the estimate that I got, this 1035, 1026 number, is really close to this 1050 and is close to how it's traded in the last 2 years or so. So I don't think it's a crazy number. If anything, I'm a little surprised that my estimate is so in line, because essentially it shows that these absolute models have something to them, and it shows that euphoria always comes down back to a more rational valuation, or that you really run the risk that it will. So if you invested in 1-800-Flowers anywhere here, you're probably not happy with the results, but there's a reason why it came down. It came down because the cash flow, the cash that they were generating, did not match what they were trading at, really. You'll also notice that they don't have a P ratio right now because their net income is negative, and they don't have a dividend yield of any sort. They don't really buy back shares either. They've bought back a tiny amount. Right now would be a better time to buy back than anywhere over here, which to be fair, they weren't. But yeah, that's just something to note. So in summary here, I was actually surprised to see that 1-800-Flowers wasn't very overvalued. There's clearly a buying point here, assuming there's some sort of reversion to the mean for this company. And I know recently, maybe 3 months ago, it was trading at around $6 a share or $7 a share. If you would have bought it then, sold it at $10 a share, that's a great return. That's like 40% in less than a year even. So there clearly is a buying point here. If it goes back down to $7, I would say it's a pretty compelling buy, especially because it seems like recently they've been having some layoffs, having some restructuring and automation. So it seems like they are working on getting those margins. However, the negative growth lately and the positive free cash flow coming largely from written down cost of restructuring, the risk is there. So essentially there's negative trends, and investing in this business will largely depend on your conviction that it can revert to the mean with revenue growth, margins, and free cash flow generation. Do you believe it can revert to the mean? And these next 2 years will be a big test for them, in the sense that most analysts are predicting that they're going to go from earning $2 billion in 2023 to $1.85 billion, which is a pretty big drop. Now, among that pretty big drop, are they able to improve their margins? Are they able to keep up free cash flow in a very healthy position? If they can do that, maybe they'll be very resilient for when they are in a better situation with revenue growth. Now, they're also very vulnerable to economic downturns. So if you're a person who's like, I believe there's going to be a big economic downturn, or I only want companies that will survive a nuclear winter, clearly this stock is not for you. Gift baskets will be some of the first to go when there's a global recession. So here I'm going to ask, can you tolerate the risk? Can you invest in a consumer discretionary company that does, to be fair, they do some business to business, but still, it's a very discretionary sector. They also have some near-term headwinds. So can you tolerate that risk because you think the mean is going to revert, because you think there's more inherent value in the business? Can you tolerate it? Or is the risk either too much for you or just doesn't fit your profile? This is something that you have to ask with every potential investment that you do, and that's where the nuance lies. Now, with that said, I hope you enjoyed this video a ton. It was very fun to analyze 1-800-Flowers. I hope that if you have any questions or you want me to analyze any stock, you'll comment down below and you'll subscribe and hit that notification button so you know when I make new videos. With that said, thank you so much for watching, and I hope you have a great rest of your day.